I have said many times on the channel that I'm very bullish on the defense industry for the next, 10 years for pretty obvious reasons, which we're going to talk about in today's video. But as we're having the rally in the stock market into a lot of the hype stocks, as money rotates around, it's actually going into, Bed Bath and Beyond and into all those stocks. And it's coming out of the recession-proof type of stocks like NOC, Northrop Grumman, like Lockheed Martin, like Huntington, all the defense names, a lot of the pharma type of names, and I'm looking around and trying to find potential opportunities where I can take advantage of this, euphoria in the market and actually establish position into such names. So in this video, we're gonna take a look at NOC stock, which is down around 18.5% year to date. While the S&P is up, it's down 18.5%. We're gonna take a look at it and determine in my valuation model if it's a buy right now or not. And if it's a buy, what is the best price to buy NOC at to get a double over the next 5 years? And once I determine this price, I put in a price alert in my broker account and I get notified whenever NOC hits my specific price target. But NOC, as many of you know it, doesn't need much of an introduction. It's a defense contractor. They have operations in air, in cyber, in land, in sea, in space, and advanced weapons, and many other areas. You can go and check the investor relations page and read more about the specific industries the company is involved into. They have a sales mix of around 87% domestic, so they heavily rely on the US government, which could be potentially some type of a risk that I'm going to mention a little bit soon, and 13% is international. Now, the main reasons I'm bullish on defense for the next 10 years as buy and holds is mainly the stability of their business. For example, NOC has a pretty big backlog, which gives it more stability and it allows it to return a lot of value to shareholders in terms of dividends, which they have been raising every single year, in terms of buybacks, where you can see the shares outstanding actually going down. This is what I'm looking for, as I believe the next 10 years are going to be very, very choppy with a lot of inflation, the Fed hiking rates and cutting rates and all type of things. And it really affects a lot of business models. But you have the defense stocks, which have a bulletproof business model and can really take advantage of depressed prices and actually buying back stock, returning value to shareholder. And I believe this will give them multiple expansion over other tech companies and other companies that have, their earnings up and down all over the place. If they have more stability, like, NOC actually has and Lockheed Martin, I believe they could get a multiple expansion in the, future, which is why it's important not to overpay for them. And this is what I'm really talking about. For example, NOC gave an adjusted free cash flow outlook from now till 2025. Most companies can't even see what's going to happen next year. But NOC can actually do that. Why? Because of their backlog, which is growing a lot. It actually went down a little bit, which is, a little bit concerning, but I don't really believe it's a big concern with the company. I believe it's going to keep, growing, as they have backlog, which is double their sales, if I'm not mistaken. And they expect a 20% CAGR for free cash flow growth from 2022 to 2025, which is again amazing for the company. They reported guidance for 2023. One of the reasons the stock went down is their EPS actually was lower than expectations. I believe it was 257, and now it came 22.45, which is, a little bit of a miss. But again, this is Wall Street. They just look at the next quarter or the next year. I don't believe this is a big deal, for the company. Now, one of the reasons the stock is going down, not just from the EPS guidance miss, not just because of the rotation from value to growth, but also because of some concerns about potential cuts in defense spending, as we have a new Speaker of the House in the United States, and there's some type of deal, which I didn't look into, that whenever he got elected, he made some deal to cut defense spending by $75 billion. Now, I don't know if he's going to do it or not. I don't know what's going to happen in the future, but that could be one of the reasons why NOC is selling off. But if they do cut defense spending for 2023, I don't really see how they're going to cut it from 2023 to 2030. We have a lot of geopolitical issues. NATO is increasing defense spending by like 27%. I don't know how the United States is going to keep cutting defense spending with all the geopolitical issues, Russia and Ukraine, China, North Korea, and a lot of, kind of things that we have. I don't believe this is going to be a permanent type of cut. I believe maybe they cut it, in 2023, but I don't see consistent cuts. I see them increasing it a lot actually in 2030 to 2032. Now, it would have been a little bit better if NOC actually had a little bit more, international exposure, because NATO is going to hike them much more than the United States, as they are more vulnerable in their military position. But again, it's only 13%. They would have been better if they had a higher percentage, international. But again, I don't believe this is a big concern in the long term for NOC. Now, looking at a basic PE ratio, it's trading around 20 times earnings. It shot up all the way up to around 24 times earnings, and now it's back around 20 times earnings. Now, the mean PE ratio is 16.5 for NOC, and now it's trading at 20 times earnings, which you could argue that the company is a little bit overvalued on a historical metric, but this is not enough. Now, if we compare NOC to another player, which is very popular, like Lockheed Martin, NOC is trading at 20 times earnings, but LMT, Lockheed Martin, is actually trading at 17 times earnings. Both are trading higher than their historical average, but you could see that they were pretty much aligned, and even LMT was trading higher than NOC, but since 2021, NOC has taken the lead and is trading much higher than LMT. So maybe the gap is going to close in the future, and they're going to trade, together again. Either LMT is going to go up, or NOC's PE is going to go down. And I believe the NOC's PE is more likely to go down than LMT's PE actually, going up. So we'll see what really happens with that. But yes, NOC is trading higher than Lockheed Martin, but NOC actually has higher expected revenue growth than LMT, which could be one of the reasons why, it's trading a little bit higher. But this is really not enough for us to determine if NOC is a buy or not. We have to look at my valuation model to really determine that. Now, NOC made around $36 billion of net revenue in 2022, which I put in the current revenue. I put in 5% revenue growth every single year for 2027. Now, the analysts are expecting anywhere from 5% up to 7% and 6%. Now, this is not something I want to bet on. I believe a sustained 5% is pretty fair for the company. Their current net income margins is around 10.9%, so I use the same one, 10.9%. I used a 17 PE ratio because I believe, a 20 PE ratio could not be sustainable for NOC. And maybe it is sustainable, but this is not the scenario I'm going to bet on. And I'm going to show both scenarios in the future, as I believe they could get some type of a multiple expansion, as I said, because of their stability of the business. But we can't just bet on the best case scenario. We have to guarantee ourselves some type of a double on the worst case scenario. So using a 17 PE as a historical average, I put in 3.5% for a dividend, but it's not the dividend, it's 1.5% for the dividend and 2% for the buyback. So I combine them together to include the shareholders' yield and the valuation model, as NOC returns all of this free cash flow to shareholders. So taking all of this into consideration, the upside is only 46% over the next 5 years, or 9% compounded every single year for the next 5 years. Now, the only way this could change is if NOC keeps trading at 20 times earnings. And if this actually happens, then the upside is around 69% over the next 5 years, or 12% compounded every single year. Now, this is really not bad at all, in my opinion. But if you're actually looking for a double on NOC for over the next 5 years, my valuation model shows that we have to buy it somewhere close to $324 per share. But looking at $324, I mean, it seems pretty much impossible, as this is pre-COVID, it's pretty much 2019 levels. I don't know if the sentiment is going to get as bad as that for it to trade back at $325, but I would personally not pay more than $375 for NOC. Now it's back at the support line. It might hold it. If it doesn't hold it, it's most likely going close to $375, which could be an amazing, buying opportunity. So again, if you're happy with a 9 to 12% annual return for the next 5 years, NOC could be a buy for you at those prices. But for me personally, I'm not willing to pay more than $375 for NOC. I'm willing to open a position around there and then kind of dollar cost average into the position and build it out if it gets to $324 per share. But looking between NOC and LMT, both are still expensive, but I would rather buy LMT at those prices than LOC. So this is my analysis for today. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.